All right. Well, good afternoon, everyone, and welcome to our webinar, Mastering Life and Disability Insurance. This is our fourth session in our Beyond the Portfolio series. And over the past few weeks, we've heard from Medicare expert Jamin White, family caregiving expert Anna Lee Kruger, and long-term care expert Scott Olson. Now, if you've missed any of these sessions, they're available on our website in the webinar tab. And they're great sessions. So if you haven't had a chance to listen to these, I'd encourage you to go back and do so. And just as a reminder, today's session is also being recorded and should be available on our website sometime later tomorrow on Thursday. Now, if you have questions during today's program, please type them into the Q&A box or chat box, and we'll get to them towards the end of the webinar. Now, today I'm very excited to introduce our guest, David Gastwirth. David has been in the insurance business for over 30 years, and I think he epitomizes the 10% rule, which highlights that the best and most dedicated professionals rise to the top and stand out because of their exceptional abilities. You know, it took me a long time to find someone in the insurance business who I believe had both the knowledge and the integrity that gave me the comfort level to recommend them to our clients, our friends, and family. So I'm truly grateful to have met David about 8 years ago. And since we've met, David has successfully worked with many of our clients, and he's helped me even secure my own life insurance policy. Over the years, I found him to be great with both simple and complex insurance needs, and he truly shines when it comes to the advanced insurance strategies for estate, business, retirement, and charitable giving planning. So as an independent insurance strategist with a wide range of carriers at his disposal, David is great at matching clients with the most suitable providers and at the most cost-effective solution. So I'm thrilled to introduce to you my friend and colleague, David. Welcome to our program today.
Thank you so much, Scott. I appreciate the opportunity to address the group. And as always, it's always a pleasure to work with the folks at Century Management. I am going to bring up my deck for this presentation, and we'll jump right in. I just want to confirm, Scott, that you and the viewers are currently seeing. Okay, so there's a couple of handsome faces right there.
Yeah.
We've got those. Let me just move this out of the way there. Hold on 1 second, sorry. Okay, here we go. Wait, no, still trying to navigate this. Where is that? Can't seem to get the PowerPoint to come up.
You want me to?
Oh, I've got it now. Okay, sorry about that.
Okay.
Okay, so there we go. Okay, let's jump right in here. So we're going to do a deep dive into life insurance and disability insurance today. And we are going to talk a little bit about some fundamentals, and then we can delve a little bit deeper into some of the characteristics and attributes that make these products important for everybody to consider having as part of their overall planning. We're going to cover the following topics. We're going to talk a little bit about how life insurance operates, the different types of life insurance that are available, when to utilize the various types of life insurance, and then we're going to pivot and talk a little bit about disability insurance, disability income protection coverage, the different types of disability protection, group disability versus individual disability coverage, and then the various uses for disability contracts. So let's start with how life insurance operates. So definitionally, life insurance is a contract between an individual, which we refer to as the policyholder, and the insurance company. The policyholder is required to pay premiums, and in exchange, the insurer agrees to pay a lump sum, which was referred to as the death benefit or the face amount. to whomever the designated beneficiaries are at the time of the policyholder's passing, at the time of the insured's passing. The purpose of the life insurance is generally to provide financial support to the beneficiaries, often replacing lost income or covering final expenses like funeral costs. And it is important to understand that death benefits are generally tax-free to beneficiaries because life insurance premiums are generally not a tax-deductible expense. Let's talk a little bit about the different types of life insurance. Many people have heard these terminologies before. So the simplest form of life insurance is referred to as term life insurance. Term life insurance is guaranteed death benefit, guaranteed premiums for a guaranteed number of years, also referred to as the term. So term insurance provides coverage for a specific period, for instance, 10 years, 20 years, 30 years, or even 40 years for certain carriers and certain demographics. If the insured passes away while the policy is in effect during this term, the beneficiaries will receive the death benefit. If the policyholder, the insured, outlives the term, the coverage ends unless it is renewed. Upon renewal, rates increase usually 10 to 15 times what they had been prior. So as an example, if you have a 20-year term and you are alive in the 21st year and you choose to renew that contract with the carrier, that premium will increase somewhere between 10 to 15 times what you had been paying before. The insurance companies believe that anybody that renews a contract beyond the term is likely not healthy. On the other side of the spectrum, there are permanent life insurance contracts, and there are two types. The first is, again, something that many people probably have heard this terminology, whole life insurance. A whole life contract is a permanent life insurance contract that provides coverage for the insured's entire lifetime. Entire lifetime in today's market means up to age 120, and I dare anybody to live longer. In addition to the death benefit, there is often a savings or investment component that is referred to as the cash value. The cash value grows over time on a tax-deferred basis. Generally, with whole life insurance, the death benefit and the cash value will grow over time. And so if you start out with a small whole life contract, 20 or 30 years from now, it could be 2 or 3, 4 times the amount of death benefit with the growth. The other type of permanent life insurance is referred to as universal life insurance. This is, again, another type of permanent life insurance, but with this particular type of plan, premiums are very flexible. They can be raised, they can be lowered by the insured, by the policyholder, and the death benefits also can be raised and lowered over time, and you can have death benefits that remain in force forever. You can have death benefits that remain in force for a finite period of time. There's a tremendous amount of flexibility associated with a universal life chassis. So the policyholder can adjust the amount of premium paid and the coverage level. So when does somebody best utilize term life insurance? Well, term life is best suited for individuals who need life insurance coverage for a specific period or a specific financial responsibility. A couple of situations where term life insurance is usually a good option would be, one, if we want to mitigate the risk of a premature passing to provide family with income protection. And this is the most usual use of a term life insurance policy. Young married families who have a responsibility to spouses or children would often utilize a term life insurance contract to mitigate the risk of a premature passing. The same can go for paying off debts like mortgages or business loans. And this life insurance provides immediate liquidity to alleviate those debts should there be a premature passing. On the business side of the ledger, term life insurance can be used to provide what's referred to as key person life insurance coverage. If a business owner has a key employee and the business would suffer financially at the loss of that employee from a premature passing, often business owners will acquire a life insurance policy on the life of that key employee to provide the business with liquidity at the time of that employee's passing, as long as that term life is in place. And another business use would be for buyout liquidity. If Scott and I are business partners and something happens to me, Scott needs a liquidity event to be able to buy my family out of the business, and often life insurance will provide that liquidity. So those are four general ideas on where term insurance might be utilized. Well, let's look at how you might utilize permanent life insurance. So let's talk about whole life. Whole life insurance is a type of permanent life insurance, again, that provides lifelong coverage and cash accumulation. It offers tax efficiency, creditor protection, and several other attributes that make it an appealing product choice. So if a client said, I would like to put away additional dollars in addition to my qualified retirement plan and perhaps my Roth IRA and perhaps my 529 plan and perhaps even my taxable account with Century Management, we could utilize after-tax dollars going into a whole life contract that would grow on a tax-deferred basis and ultimately can be withdrawn on a tax-free basis under Section 7702 of the Internal Revenue Code, all along maintaining a death benefit that would be tax-free to the beneficiaries if the insured were to pass away. Alternatively, universal life, again, also a type of permanent life insurance. This is a type that provides flexible premiums and coverage that's best used solely as a lifelong life insurance chassis and or to utilize a long-term care solution, which some universal life contracts can provide an additional benefit that could be utilized to mitigate the risk of a long-term care event. So whole life would be much more for cash accumulation. Universal life would be much more for straight death benefit or for creating a long-term care solution for yourself. Let's flip over and talk a little bit about disability income protection. Disability income protection, often called disability insurance, is designed to replace a portion of one's income. If you're unable to work due to an injury or an illness, we want to make certain that you have an influx of cash that replicates what your after-tax income was prior. This is going to provide you with financial support during this period of time when perhaps physically or mentally you're unable to perform the duties of your occupation and thus to earn income. This would allow you to meet your expenses, your essential expenses associated with your lifestyle. So disability insurance on a disability income protection basis is going to provide you with an income stream that replicates your income, replicates what you were earning before you were unable to earn an income due to an injury or an illness. There are several types of disability income. There are several types of disability insurance. The first one we refer to as disability income protection, also known as long-term disability. And this is going to provide income replacement for extended periods of time. This is not if you break your leg and you're out of work for 6 or 8 weeks. This is for a long-term disability, a long-term prolonged injury or illness. There will usually be a waiting period, most normally 90 days. And these policies and these benefits can last for many, many years, or even, quite frankly, to retirement, depending upon the policy that you choose. The other two types of disability protection are disability buyout insurance. Now, you may recall we talked about this a minute or two ago on the life insurance side. So again, if Scott and I are business partners and I suffer an injury or an illness, the disability buyout insurance can provide Scott with, or the business, with an influx of cash, which can be used to buy me out of the business if I am no longer going to be able to operate as a partner in the business. So it is a specialized type of insurance, and it is designed to help fund the buyout of the business owner or the partner who becomes permanently disabled and who can no longer participate in operating the business. It does ensure that the remaining business owners have that influx of cash, that necessary funding to buy out the disabled partner's share. And it also allows the business to continue operating smoothly without having to take on debt or having any additional strains or conflicts. The other type of business disability insurance is what's referred to as disability overhead expense coverage. And disability overhead expense would cover the business if something happened to me. Again, Scott and I are business partners in this example, and something happens to me, I'm injured or I'm ill, and this is going to provide an influx of cash each month to help cover the ongoing operational costs of the business if the owner becomes disabled and is unable to work. This keeps the lights on. This helps to fund salaries. This will provide the business with cash to continue without running into a debt situation. But unlike this personal disability insurance, which replaces lost income, overhead expense focuses on keeping the business afloat by paying its regular business expenses during an owner's disability. So pivoting back to income protection disability, long-term disability coverage, there are two types. There is group disability coverage. Group disability coverage is generally provided by an employer or an association or a professional group as part of a benefits package. So if somebody works for a medium to large size firm, they will often be offered a disability income protection, either employer paid or employee participatory. And I will always recommend that if that is something that's offered to you, that you take it, because it will be the most cost-effective way to obtain disability coverage. If you are working for yourself or a small organization that doesn't have a group long-term disability contract, like myself, I'm the owner of the business. We're a small organization. I have always had to purchase my own disability coverage. So this is purchased by an individual directly from the insurance company, and it has nothing to do with any employer or organization. Individual disability insurance will also come into play if there is a gap between the amount of income that somebody generates and the amount of group long-term disability coverage that is offered to them through their employment. So if somebody has a gap and they want to fill that gap, they would then layer an individual disability contract on top of the group disability contract. So some attributes. From a cost perspective, group is going to be far less expensive than individuals, because the individual, the insurance company is only insuring one person. With a group, the insurance company is insuring 20, 30, 50, 100, 1,000 people. Flexibility. Group coverage is far less flexible than individual coverage. Group coverage is going to be, there's going to be a plan design, and you're going to perhaps have an option of 1 or 2 or 3 plan designs, and you've got to choose one. With an individual contract, you can custom tailor the disability contract to fit your needs specifically. From an underwriting standpoint, Group coverage is generally just underwritten through the census. They look at the demographics of a group, how many males, how many females, what are their dates of birth, and therefore their ages, and what are their salaries, and then they put together a plan. There is no specific health underwriting other than perhaps a question or two, have you been at work for the last 90 days? With an individual plan, it's going to be fully underwritten. You will have to qualify to obtain individual disability coverage. From a taxation standpoint, if an employer pays all of the premiums for a disability contract and does not charge the employee anything for the coverage, the benefit under a group long-term disability contract would be income taxable to an insured if the insured became disabled. If the employee is picking up the cost of the insurance, or the employer is charging the cost of the insurance to the employee as part of their income, and thus they are paying a small tax on that, then the benefit would be tax-free to them. Individual coverage is 100% tax-free because the premium is not tax deductible to the insured on an individual contract. And from portability standpoint, if you leave an employer, you must leave group long-term disability behind. If you have individual long-term disability, you may take it with you regardless of your occupation or your employer or your income. So the various uses of disability coverage. So we've got income protection. We've been talking a lot about that. Disability insurance typically will replace somewhere between 50 and 70% of your pre-disability income. The reason, again, that it will replace only a percentage is because that benefit would normally be tax-free to you. Key person. You may use disability to create a key person benefit to an organization. So if I'm the key person to Century Management, if I'm an employee of Century Management, and the business will depend on me being there, and if I become disabled, that will disrupt the business financially, they could create a disability key person contract on my behalf, which would pay the business if I were unable to work and help the business to maintain its profitability until they found somebody to replace me. Disability buy-sell, we talked about this prior. Again, this is a type of insurance that funds a buy-sell agreement between business partners if one partner becomes disabled and can no longer work. It will ensure that the remaining partners have a financial resource that is available to them to buy out the disabled ownership interest in the business. And lastly, you've got overhead expense. Again, we talked about this prior. This type of coverage is designed to help a business cover their fixed expenses if a key person becomes disabled and is unable to work. This coverage ensures that the business can continue operating despite the loss of an owner or a key person, a key person or key employee. So that is a very, very simplistic and high level insurance 101 on life insurance and disability insurance. And I'm going to open up the floor now to any questions that may be out there.
Yeah, great. Thank you, David. So let me ask you, on a life insurance death benefit, does that increase with inflation? So 30-year-old buys $1 million 20-year term policy. Are those payments fixed for the whole 20-year term? The death benefit fixed? How does that work?
That's a great question, Scott. Let me just open this back up here. There are different types of disability contracts out there. And so the ones that we always want to gravitate to have the following attributes. Number one, they are guaranteed renewable, which means that the insurance company cannot cancel them as long as you pay your premium.
This is for life or disability?
This is for disability insurance. When you talk disability, yes. So guaranteed renewable means that they cannot increase the premium and they cannot terminate the coverage as long as you pay your premiums. So premiums are guaranteed on disability insurance, and the coverage is guaranteed as long as you pay your premiums. So non-cancelable, guaranteed renewable is the bellwether on a disability contract.
And David, if so, and over that time, somebody is getting an increase in salary, that coverage goes up with that increase in salary?
So there are riders that are available for individual disability contracts, individual disability income contracts. One is referred to as an annual increase rider, which will raise the benefit by a percentage, 3%, 4%, 5% each year to keep pace with ideally somebody's increases in their income. If you have large increases in your income, we will normally recommend that somebody purchase as part of the initial contract what's referred to as a future purchase option. Future purchase option. If you are making $100,000 a year and we insure you for $60,000, $5,000 a month, and next year you get a raise to $200,000 a year, well, now you have a pretty big gap. You've got a $60,000 gap. With a future purchase option embedded in your contract, you can come back to the carrier and you can request, show them your new W-2, show them your new pay stub, and you can request that they increase your monthly benefit from $5,000 a month to $10,000 a month to cover the new salary you have. That will essentially double your premium because you're doubling your coverage.
Got it. And if a disability gap occurs, can private disability amount bring up the amount equal to 100% of your pre-disability income?
The insurance carriers are definitely going to limit the amount that somebody can have because they do not want it to be more advantageous for you to be laying on your bed flat on your back than to be at work. Insurance companies are profit centers for themselves. And so if they're able to not pay you a disability claim benefit, that makes them more profitable. So the only time that you'll find that will happen is if, let's say, I work for myself and I insure myself to 60% of my current income. And then I decide to go work for a company like Century Management that has a group long-term disability contract in place that covers me for 60% of the salary that I'm being paid by my employer. If I keep my individual coverage and I layer the group on top of it, it's conceivable that I could be insured for 100% or even more of my current income. But most people won't do that.
So it's not, we're all going to die. So you got that bucket for life insurance. We're not all going to get disabilities, but statistically, can you share maybe some industry numbers that what is the probability of someone having a disability event versus a premature death? And where would you put the priority if someone had limited funds, or what should they have first, disability coverage or the life coverage? How do you think about it?
Again, if you have the option of participating in a group long-term disability plan through your employer, you should always, always, always do that. So that would be my sage advice there. The probability of somebody dying is 100%, okay? But the probability of somebody dying prematurely, so term life insurance, which represents the largest percentage of the risk mitigation about premature passing. The statistics are that less than 2% of all term policies that are in force at any moment in time will actually pay out a death benefit because, one, insurance companies underwrite the insureds before they offer them coverage. So they are weeding out people that are, largely unhealthy. Two, the average demographic of people that own term insurance are younger than older. And three, because the term will ultimately end at some point in time. And so if somebody who's 30 purchases a 30-year term at 60, their coverage is going to end. And the statistical likelihood of somebody dying before the age of 60 is infinitesimal when they're 30. It's a very small number. The likelihood of someone dying when they're 70, when they're 60 is a much larger percentage and a much larger demographic. For the disability insurance, the statistics are far higher. 27%, this is the current statistic, 27% of all people employed in the workforce that are younger than the age of 60 will experience a prolonged illness or injury that is for more than 1 year at one point in their life. So 25%, 1 in 4 people are going to experience some sort of prolonged illness or injury prior to the age of 60.
So how do you go about mixing short-term disability coverage and the long-term disability coverage? Those are two different things, right?
So most employers will offer both if they're a large enough employer. And short-term disability is going to cover somebody essentially for the first roughly 90 days. And it's going to be a very small percentage of somebody's weekly pay. But it is going to provide them with a stopgap. Long-term disability is for illnesses or injuries that are prolonged. That's why most insurance contracts will have like a 90-day waiting period. And when possible, we would instruct and recommend that our clients have 3 months of their living expenses in savings to bridge the gap between the time that they would become disabled and the time that the insurance company would start to give them their benefit. Have that 2 to 3 months worth of your living expenses in savings readily available should you need that.
So how many times or how often do your clients over your 30 plus year career, how many claims have been made on disability? I mean, life, there's obviously a lot, but how about disability claims?
I would say that, neither the life or the disability is all that often. I probably have seen in my 30 plus years, maybe 75 or 80 disability claims, so 2 or 3 a year. And on the life insurance, many of my clients have passed away in 30 years, hundreds and hundreds of them. But did they have insurance at that period of time when they passed away? If they had term and it expired before they passed away, then they weren't making a claim against the policy. Many of them had permanent life insurance policies, and thus there was a death claim that was made. But again, as I said, the probability of dying is 100%.
And any rules of thumb or just your own thoughts on how much life insurance somebody needs? I know that can differ depending on many situations, but just generally speaking, any thoughts on that?
So if we're talking about income replacement on the life insurance side, the general rule of thumb is that somebody should have somewhere between 12 and 15 times their average annual compensation. The reason for that is we want to be able to provide the surviving family members with an income stream that mimics what they were bringing home before they passed away. We're not looking to make anybody rich, but we are looking to be able to maintain a lifestyle for surviving spouses and children. We don't want people to feel as though they have to move out of the home that they've been living in for a while. We don't want to feel that the kids can't continue to be in a private school if that's where they were, or go to summer camp if that's what they were doing, or go on 2 or 3 vacations a year. Just because you've lost a parent and consequently perhaps the breadwinner in the family does not mean that somebody's lifestyle should change dramatically. So the goal is to provide a lump sum of cash that can be managed professionally and provide the survivors with an income stream that looks and mimics what was being brought home prior to somebody passing away prematurely.
So on the individual side of the equation, not key person insurance, on the business side, who should own that policy? The husband should own it. The wife should own it. Should you put it into an irrevocable life insurance trust? How do you think about that?
Simplistically, most insureds will also be the owner of their own policy, and their spouse or loved one will be the beneficiary of their policy. So as an example, I am the owner of my life insurance policy. My wife, Lauren, is the beneficiary of my life insurance policy. When your situation becomes more complex, whether it's because of family dynamics or because of the size of somebody's wealth and affluence, we will often look at trusts as ownership for a life insurance policy. If we have a situation where we have a level of perhaps distrust between spouses or business partners, we will have them cross-own each other's policies so that they are responsible for making certain that that policy remains in effect. That is often the case in a divorce settlement where we have an ex-spouse who says, I want to be the owner as well as the beneficiary because I don't want my ex-spouse to be able to change the beneficiary or lapse the coverage. So it really depends on the situation.
So what if it wasn't owned that way at the beginning, but down the road, divorce situation comes up? Can you change the ownership structure?
Yes, you can. Yes, you can.
Tax consequence to doing that?
No tax consequence.
Okay. And life insurance payouts are tax-free to the beneficiaries?
Income tax, capital gains tax free. They could be estate tax includable, depending upon if there is an estate tax inclusion. But for all intents and purposes, life insurance is income tax and capital gains tax free.
What would you say are some of the biggest mistakes you've seen people make when it comes on the life insurance side? I know sometimes when we're doing plans for clients, we stress test their plans. What if there was a premature death? And you go through all the iterations, and I find that sometimes people just don't like to talk about it. They kind of bury their head in the sand. But anyway, what's your experience with that or mistakes?
So the couple of big obstacles that I find are pretty prevalent in my experience. Number one is young couples, young families who should have coverage that's guaranteed and premiums that are locked in for a long period of time will often decide to take a shorter term. The shorter term is going to be a less expensive premium. So married couple has a couple of young kids and they both take a 10 or a 15-year term. And then in 10 or 15 years, they've got to requalify for new coverage at a 10 or 15-year-old older age range and premiums that are going to be sizably different than they were paying before. They may have had a significant change in their health. So in short, being short-sighted about the term length, if you were talking about term insurance,
Sure,
is an obstacle that I would want clients to be aware of. And the other is not taking enough coverage. I have never, Scott, in my period of time in this industry, ever been at a funeral and ever heard someone say, oh boy, he had too much life insurance. It's never happened. So, my rule of thumb, 12 to 15 times. I'm not in the business of spending people's money. And at the end of the day, it's ultimately the client's decision as to what they want to have. But when someone says, oh, I'm making, $1 a year and I want to have $3 of coverage, I'm thinking they should have $12 or $15 of coverage. I can only recommend what they should do, but I cannot force anybody to do it. But being short-sighted about the term length or the amount of the coverage are two, often they're conversations I'm having very often with clients. The third one is picking the wrong product. And so I use an analogy. While term insurance is temporary and likely you will throw your dollars away on a death benefit that will never materialize because hopefully you will outlive the term, you can think of it as renting the insurance, okay? Versus a permanent life insurance policy that is more like owning the insurance and will be there likely for you forever and will benefit your family. If we have the same dollar amount of premium for $1 million of term, let's just say that's $1,000 a year, I'm making a number up, to spend $1,000 a year for a permanent life insurance policy might only buy you $150,000. And so the analogy that at least I used to use when I lived in Manhattan was, you're a family of four. Is it smarter to rent a 3-bedroom apartment for $1,000 a month or buy a 600 square foot studio apartment for the four of you to live in? Yes, I want you to buy a real estate or buy your insurance, but if it's not big enough and you're going to be on top of each other, it's not appropriate. So the analogy is, don't spend the same dollars to buy 150,000, because if I have to show up at someone's funeral with 150 when it should have been $1 million, I haven't done my job. And so having the right amount, having the right type, having the right term length, those are all fundamental, mistakes that people will make that I would hope that we could, instill in them a little bit of knowledge and help and power.
That's great. And so can the amount of the death benefit be changed either up or down in future years after the initial amount?
So for term life insurance, you can reduce the face amount because you are alleviating the insurance company of any of that risk. If you've got $1 million policy and you suddenly want it to be $750,000, they'll be happy to take themselves off the hook for $250,000 not to have to pay out if you pass away. Conversely, you cannot go to the insurance company and say, I have $1 million, I'd like to double it to $2 million without qualifying again at whatever your current age is. So for us, we will try to encourage clients to take a little bit more than they perhaps think they need if they feel as though they will have a significant increase in their income over the next 3-5 years and would want to increase the coverage. I'd rather that they have more, because I won't be able to get you more if there's been a change in your health between inception and when you want more. On the permanent side, depending upon the products, the death benefit can grow over time. And so when people have a desire to have a permanent life insurance policy and have the funds available to have a permanent life insurance contract that's appropriate for them, we can structure those contracts so that they have an increasing death benefit over time, and that therefore they are keeping pace with whatever that increase might want to be for the insured.
And if the death benefit amount is reduced, does the premium also get reduced?
Yes, sir.
Okay. On a whole life policy where you're accumulating cash, right? That's one of the products to use for a cash accumulation strategy. Is that similar to an annuity in that could be considered a premarital asset as the cash builds up? So for people that go through divorces, or maybe you have an athlete or somebody that could be a target, and this is a way to protect yourself. Can you talk about that?
Sure. So life insurance is not only a creditor protected asset class, meaning that if you get sued or you file for bankruptcy, it is a non-creditor attackable asset, but it is also a predator protected asset. And I'm not referring to, Dateline NBC. I'm referring to a future ex-spouse, a future ex-business partner. So we often will use life insurance, permanent life insurance contracts for children of affluent clients. And the purpose is not only to accumulate cash for this baby or teenager or whatever for them to use later on in life, but it is also to insulate certain amounts of assets from, and I'll use my sons as an example. My boys are in their 20s, and we have whole life policies for them because they, one or both of them will likely have a starter marriage, and so if and when they do get married, and if and when they were to divorce or be divorced from their spouse, that asset would not be an asset that would be attachable in the divorce decree.
So you did that for them, not necessarily for a death benefit that one of their future loved ones, spouse or kids, would benefit from, but rather protecting their assets.
Correct.
For them, and that cash value is growing tax deferred along the way. And when you and I've talked on that, as the cash value grows over time, that can become very significant, and you could pull out, I don't know, 80 to 90%, a very high percentage, as long as you leave, there was some formulaic death benefit, you have a piece you have to leave in there to cover the death benefit, but you could pull out all that cash tax-free. So kind of like a Roth IRA in that respect. Is that right?
Yeah, it's basically, think about it as a Roth IRA that does not have any income or contribution limitations to it. In our minds, we wanted to build some insulated assets for our children that could be used someday to start a business, to be a down payment on a home, to be, for whatever reason they wanted to have it available to them. But we wanted it to be in a vehicle that has certain attributes associated with it that make it appealing and are unlike other vehicles that are out there. So after tax dollars in, tax-free growth, tax-free withdrawals, creditor and predator protection, a death benefit if, God forbid, somebody were to pass away. All of those are attributes that you can only find in life insurance contracts.
Okay, that's great. Well, David, I think this has been, I always take notes every time we talk, even though we've been talking for a lot of years. And
sure.
So this has been really great. So I appreciate your time. Any final thoughts just on life or disability? Or
I'll say that on the disability insurance, on private individual disability insurance, I want to acknowledge that those contracts are expensive. And when I sit with clients and I show them either filling the gap between what they have with their employer and what they're earning, or if they are they work for a small company or they're self-employed, the immediate reaction is, oh, this is very expensive. And so what I say to people is, you're right, it is expensive. And I do want to sort of set the expectation that these contracts are expensive. But if you think about it this way, Scott, I am your potential employer, and I'm going to give you two options with respect to your compensation. One is going to be, I pay you $100,000 a year, and if you get sick or injured, I don't know you, go away. The other one is, I'm going to pay you $95,000 a year, and if you get sick or injured, I'm going to make sure that your salary is covered 100% of what your take-home pay was. Which employment agreement would you choose? Sure. And so that is something that's important for your clients and the guests here to know, that term life insurance is relatively inexpensive. Permanent life insurance can be somewhat expensive. Disability insurance can be expensive, but you've got to put it in perspective, and having something will always be better than having nothing.
Great. All right. Well, thank you very much. Really appreciate your time. This has been wonderful. So
thanks again for the opportunity.
David, thank you all for listening, and we'll be meeting up again next week, talk about trust and wills. So, okay. Thank you, everyone.
Thank you so much.
Bye.